afternoon, everyone. Thank you for joining us. Decarbonization in real estate is no longer a question of vision. So most of us here in the room get habits. So the harder question is always execution, implementation. So who pays for it? Who carries the risk? And who is actually going to make it work at the asset level? So today we have three perspectives that we are rarely able to be seated same table. So we have an investor who decides where the capital goes, and we have a banker who decides what's get financed, and a sustainability leader will deliver results on the ground. So our goal today is not to repeat the usual sustainability narrative. It is to have an honest conversation about trade-offs, constraints, and what a realistic transition pathway looks like for real estate in Singapore and Asia Pacific. So let's get started. So in terms of how does the money actually look at? So maybe I start with that. Okay. So when you are evaluating the building for condition or for rental investment, so how much of the sustainability case is driven by hard financial metrics such as occupancy, asset liquidity, resilience, versus the softer ESG components from your investment funds?
Good afternoon, everyone. My name is Mia. I represent SC Capital Partners, and I'm very honored to be here today to be able to share my views in this panel. And I have to be very honest that I do not regard myself as an expert, but I'm happy to share my views with regard to sustainability from the perspective of a fund manager slash asset owner. Just to preface that what I'm going to share, it may not be the most, it could be potentially controversial, not the most popular opinion, but from my point of view, it's a very pragmatic approach towards sustainability and in this case, private equity real estate investment. So she did ask the question, where does the money go? But I guess before to even answer the question, we have to be clear which money I represent. So in today, you'll be hearing views from three different perspectives, and I represent the opportunistic real estate fund. So on the screen, I suppose what you guys can see is a set of skills. And to answer his question, we need to take a step back on what exactly this means for an opportunistic real estate fund manager. So for those who are not aware, when we use the word opportunistic real estate fund manager, we usually look into the investment thesis as well as the holding period of the asset as well as the asset class. So how do we decide where the money goes? It depends, or it differs very different, say, to a real estate developer, which I listed there, as well as a business manager or even a family office, because each of these actors are being powered by different motivations. So when I have a set of skills, all right, usually on the left side, we have the ESG pressures, the compliance, the commitments. And again, for the different actors, say for a real estate developer, REIT manager, PRE manager, it's all different. And that has to be balanced with something I think that doesn't change at all. And these three things would be number one, the exit liquidity. Will this asset that you invest in be harder to sell in X number of years? Let me give an example when I say perspective is different. A REIT manager, they have a longer runway, a longer capital runway, and holding period, usually about 20 years. So their considerations of whether to invest in sustainability or even what sustainability initiatives to invest in will differ from the company that I'm in, because we will look into, say, a holding period of 5 years. If it's 5 years, what are the returns? If you invest in it, can you even get back the returns? Will the buyer want it? Will they even factor this in the exit strategy? What is the valuation of it when you leave? Is it something that capital market has appetite for? There are all these considerations we will look to. Number two, how we put our money in. Another thing to look into is financing costs. And this is a segue to my lovely brand here. We'll talk about banking from the banking perspective. And we are aware that sustainability-linked facilities are pricing tighter. And when the spread benefit shows up in your term sheet, it shows up in your returns as well. So this is something that we have to consider too. And third, and this doesn't change at all, regardless which actor you are, it's lease resilience. So we are also aware that multinational tenants for office asset class, they require their scope 3 commitments to be aligned with green certified spaces. And while this is not a values conversation, it is an occupancy and rental income conversation. That said, I would like to flag that what I'm sharing right now as an example is an op-risk asset class. Again, it depends and it differs on a logistic asset class, a data center, or even living asset class. Be it hospitality or senior living, it's all different. So going back to his question, where the money goes, it boils down to a set of skills, and we have to balance it where it's the best way to put the money and justify the returns. So what does not move the needle from, at least from my company's point of view, is that if you want to decarbonize, all right, come up with targets, and if it does not connect to any of these three outcomes, which are non-negotiable, then it might not be a good idea to decarbonize or at least set such goals for the project. So again, it must reach these three things: exit liquidity, number two, financing costs, and number three, lease resilience. So maybe our Anna and my segment here by saying that it's not that I want to be cynical. I would like to see it being pragmatic. I feel that we as asset owners, all right, or fund managers, we shouldn't be jumping on the bandwagon and confuse aspiration with the investment thesis. Because if we were to do that, it produces greenwashing. And that is exactly and when that happens, it produces exactly this misalignment that this panel is here to discuss today. So with that, I hand it back to Jimmy. Thank you.
So I guess in summary, what you're saying is that for assets, we can actually group them into core plus, and value add. And based on the different asset class, we can categorize and strategize different investment strategies, which has different investment timeline. And this itself is also integrated with consideration of hospitality assets, industrial assets, or even commercial assets. So when we start to break it down into the various asset type and the various asset categories of core plus or value add, based on the investment timeline, we all have different strategies that we have going on. So it's all about how money talks to us. Okay. So perhaps before I ask Justin, we always hear about money talks, but how do money talks to us? So maybe I can summarize in three ways. Then money talks to us. Okay. Justin is a banker, probably you can correct me. So money talks to us in three ways. So first way is that through the P&L. Okay. If you have a positive P&L, you have a good number, yeah, that's how the first information of how profits is generated from your company. First way. And the second way that money talks to us is about how, because you are making money in your company, you are a profitable business, you have the ability to leverage the debt. And because a banker will be more convincing that if I lend you money, it's a good bet. That you make more money and you have the ability to service the loan. And the third way that money talks to us is that when you have a very good debt control, you have very good P&L, you can invite equity process. So I can see that money talks to us in 3 ways. So I think I want to hand over to Justin with a question about how you would evaluate a proposal from a borrower. Okay. And what would you scrutinize beyond the way later? And what will be the most common reasons that you will accept, you will decline the proposal?
I'm Justin. I'm currently with China Commercial Bank. It's my 7 years here. I've been in this industry for about 18 years. Financing different various asset classes from hotels, offices to residential developments, self storages, focused on trees. This is what I'm living. I by the way, I'm not representing the bank. Just maybe as a point of view, from what the bankers point of view. I think we should take it out, but very rightly, financial spirit. Because first thing first, we look at is financials, P&L. There's so many measures to look at. I think a few key measures to look at in measures as the gear factor and cash flow. I think these are the key things, at least for the basic financing. And then the next thing that we look at is actually the industry at the point of time when you're financing. For example, the certain industry or certain may not be doing too well now. For example, China, I'm not actually on China. That's what information. But if you're financing, I mean, if someone like us for finance real estate China now, I'll give it a miss because the industry itself is not too well. So it's one of the things that we look at. And then we look at next we look at the asset itself. The industry may be doing well, the financials may be doing well, but the asset, for example, the location, or for example, it's not being maintained or less or meaningful certificate. And then corporate governance is very important. A lot of them people just think that you have the management, you have the financials, and then you can run access to corporate governance really more the most important thing. There are certain cases where you take on bosses and yet they're not comfortable with the management, the how the business to be leader miss. And then lastly whether the loans I think having the loan whether it's doing hot is of course important, but all these processes need to be aligned. Maybe give an example of having financials. I mean, this is not information of me. Evergrande, we all know that Evergrande is as a background now. They also took up from many banks, as other some of the being one. But does it mean it's doing well? No. I mean, here at least it's not offset you now. You want a situation that after we give up loan, the asset become stranded or become it becomes losses, but eventually start dropping. All of this, all the stars will be aligned. Before we actually give the loan each other. Yeah, sure. Yeah.
So I guess it's important to show good governance, and good governance actually translate back to how the numbers look like. And of course, you not only look at the short term numbers that the company is making money, you also want to look at how they finance their debt, how they manage their gearing ratio, and eventually they need to show good governance, good processes that eventually gives you the confidence that when you loan them the money, there's a good chance they trust it.
Maybe can I say one more point? Yeah. So, a few weeks ago, a bunch of bankers, we were just sitting together because normally it's organized a nationals with about bankers. So, it's actually a German bank that are doing maybe into the same financing. And we're saying that what's the key thing that we look at? Banker is saying, she look at cash flow. And the German bank guys say, she actually want to see your customers. Whether, I think, I see some of you laughing at the floor, it's actually whether there's any money markets. If the management doesn't work right, no matter how good or how bad the set the applications right, it just goes down the drain. So management is still very important. Like I said, all the stuff in my mind.
So it's important to know how money talks to you. And maybe I can progress to invite Joanne from JLL. So you actually manage a lot of assets, and you also do a lot of sustainability strategic planning. And so at asset level, how reliable would you need data to be? And how often are these investments or these financing decisions that you make based on these numbers? And how do you ensure that whatever strategies that you put in is reflective of the data, the information that you have collected so far?
Hi, very nice to meet all of you guys. Can you guys hear me? Is it good? Great. So this is a very intimate session, so feel free to raise any question and let's keep the conversation flowing. I am Joanna, so I'm from JLL. I'm the director of sustainability ops of JLL Corporate Real Estate. So as you know, JLL is a service provider and investment management firm. We have more than 100,000 employees and across various continents. So my role specifically look at our APAC portfolio, the 80 or different portfolio across Asia Pacific. And my role over here is really to give a perspective from we have our fund manager, we have our investor, and we have the occupier, meaning the one that makes the deliverable from ground. So I think one question which is quite interesting is how reliable is the operational data? So I look specifically into our scope 1 and scope 2. I think key crux is how reliable you want your operational data to be. So as you know, operational data can be directional, useful. So that's for disclosure or that's for reporting. But my role and my KPI is not for reporting just aesthetically. I need to deliver, I need to ensure each of these assets has a targeted EUI, is energy efficient office and space. So because of that, I need my data to be very reliable. Otherwise, I'll tomorrow you see me on the street, you know. So for me, two things comes to place. One is the process, meaning how do you collect your data? Another one is the technology. How do you input logic into your technology to ensure that it can automatically surface where there's abnormally and there's like errors to it. So for us, we do need to spend a lot of time and money to ensure that these are complete. So how reliable my data is, I'm actually quite confident, but of course it always needs to be developed. So previously we have our Alara platform and now we are at Gen 5. So every year we have a process to go through and make sure that you're better than the year before. Besides that, I do have to say that sometimes these operational data is also not enough for you to make to project outcomes. So these operational data is good for me to select which of my assets I want to work on, which of the asset because I already have the historical data. I pull it up. I say this asset out of all my data needs go to that. So subsequently, I have various solutions that come in, let's say, operational occupancy sensor. But the projection for this occupancy sensor requires judgment whether eventually when I invest in it, after 1 year, I still test whether this decision is good or not. So yes, operational data needs to be reliable. It's good for me to make decision grade on which asset to choose and pick, but it's not a sure way to tell me whether my solution is right or wrong. So this comes with more judgment, industry conversation, and also experience in various issues.
So I guess your time horizon with JLL is very different from Mia, whereby she's more concerned about value add assets whereby there's a very short term 5 year investment period whereby after that they can make a investment action. But for JLL, I guess you are looking at more corporate uh, direction about organizational management, how you bring sustainability, ESG into part of your culture, and hopefully this flows to your clients. Maybe you actually elaborate on that.
Sure. So I think it's similar to we also have a horizon. So like one, our horizon comes with the lease. So what you mentioned is for us to deliver, we need to think laterally across the region and inject with the specific asset. So my investment horizon is actually measured by lease. But then all this have to be linked up on a portfolio analysis to see how it brings to the corporate sustainability year on year and the reduction. So it's quite a kind of a 360 analysis that you need to put in. But all in all, still the data. You have to talk money with that food. I cannot bring that out of the picture. I will look at it in a very, very depth and then and bring it and fight for budget and get all this.
So let's stay with you first. On the mic. So where and when does this execution break down? Okay, in terms of let's say what you're trying to implement, what's committed at what level. But right now you are actually exercising your strategy at asset level. So how can you maybe address some of the disconnect, possible disconnect between portfolio strategy direction and what you are facing at the asset level?
I have to break this down to fast because this is a very real and complex situation. Because those who signed the emission reduction are not the one who's holding the money for me to go on it. So the dislocate comes seriously there. So if we look at it in a high level situation, the solution or the key recommendation to that is that when the decision is being made, there needs to be an owner, the one that's following the money needs to have a seat at a net zero council. So for JLL, we do have that. So we have a net zero council. Yes, there's a CSO team that's running it. The net zero council has each of these leaders who eventually owns this and will need for. So this honestly is level beyond my day, but this structure needs to be in place. So once you have an owner that owns certain part of the strategic CSR goal, this will then trigger down to how you want to implement it on the set level. So this is the way we look at it in a very high level form. But of course, in between, there might be situations where maybe on a corporate sustainability level, the goal is too ambitious. So that's where us, people who are working on the ground, very familiar with the asset, and say, okay, fine, if this is a reduction that you are looking at, these are the amount of costs that are required to be put in place. These are the risks that might be put in place should we not reach the target. Are we all aligned as a team, as a company to face that? So with that in mind, this is a company with all these being considered, then this is a conversation we bring forward. And even spending job on here because these are the risks that we already put way beforehand. And these are what different council owners are aware of.
Yeah, so maybe I progress on our messaging. Um, so I think when you buy a building, you actually put out an investment strategy for the building. So once the Capex level or Capex program is approved at the portfolio level, but it may get slowed down, it may in scope at the asset level. So what would be usually the main reasons that some of these advisors have in, and maybe you can share what are the challenges that you have encountered from between decision and delivery.
Thank you, GP. I guess I've been very fortunate that so far we have not experienced such a situation that GP mentioned. But that said, I feel that again it's hard to bring a perspective of an asset manager that um one of the key reasons why there will be some scoping involved when it comes to sustainability initiative, and we need to understand the why. And it's usually maybe to do with say lease uncertainty, maybe it's to do with some capital challenges. And it's not because sustainability initiatives is not popular or it's not that something they disagree with. Going back to what Joanna and what Justin said, ultimately it's really where we have to put our money where the mouth is. And if money is tight, we have to find our way around it. So far, based on my experience, very fortunate we have not reached that stage yet. Also because on my team, we do not impose unnecessary um, expectations, or should I say challenges, to the deal team when it comes to acquiring asset, requiring them to set high amounts or high level of capex for sustainability initiatives. We give them very, I wouldn't say low hanging fruits, but very practical, something that, it will look good in the exit strategy. For example, say a logistics asset in China, flat roof. So what is good and it's low cost, good returns? Solar panels. So even if let's say they say that no, we do not want to consider green certification, green building certification right now, then we'll discuss with them how about solar panels? Or better still, can we revisit it later? So it's not so much about it's not so much about oh no they do not want to work with us, but more about as in the sustainability team, sorry, we need to understand the constraints, the considerations that the deal teams face. And so it's not just the deal team, but also the finance team face. Because ultimately, at the end of the day, it is all about cash flow, and that's the reality. But then say, if let's say we have committed a green building certification or some sustainability initiatives to the LPs, then we have to disclose to the LPs if there's a change of plan. And if we don't, again, that will constitute as greenwashing. So therefore, we need to be transparent and honest. So it's good to also have the LPs on board so that they can also put again where the money amount is, so that they can be committed in the process as well. And that also speaks to what Joanna mentioned earlier. It's all about money, it's all about cash flow.
Yeah, so money talks in many different ways. Yeah, so maybe I go back to Justin about I think transition risk is a term that we probably use to identify companies that may face several kind risks in the near future. So personally, I have also audited a couple of data centers in various countries where we do a simulation of the potential flood storm risk. There are situations in 2035 to 2040, 2040, that there's a high probability that the entire region will be flooded. So there are actually two types of assets whereby we term data center as a system-centric assets whereby there are very few people. It's all about protecting the data center so it's functional. So you can put in floodgates, you can design your switch room to be on the second floor, etc. But but there are assets that we call them human-centric assets, whereby hospitals. Okay. So when the region is flooded, the hospital is disrupted, there are several things that will be affected. Patients who need medical, the medical risk or medical supply will be disrupted, and the patients in the hospital will also be affected because of various types of disruptions. So in terms of the transition risk that we have for various types of properties, so from a practical lending terms, so how do you look at all these potentially stranded assets in the next decade? And how will you have this conversation with the borrowers.
Maybe personally, what exactly should happen that before different attendees they come with a learning value or the add-on income a liability. We see in cases, for example, it's not really a real estate transaction, but you shell fund and love quoted. They should do wrote off close impairment loss of $2 million US because of because it's actually a strand asset due to change regulation. So they not like strand asset. So it's something that they should look at closely. I mean, thankfully, most of the things that almost real estate advisors all quite okay and he knows overseas. And the other thing we also look at is revenue loss because once you have that depend on that's kind of so it's one very real model. And then with Capex release as well, Capex release we're doing that. Sorry, yeah, Capex release is something I see it's a smaller moment. You end up spending a bit more money that's unexpected to kind of make sure that the asset stays relevant to yourself as well as to the bank. So the question is, as the borrowers have an honest question to the bankers. I guess these days, most at least in Singapore, our borrowers they're very smart. They usually do that what the bankers and we want, and they do it in advance. For example, you look at the new I1 unit, they actually there's a ECA trademark award, Canadian Landlord Law. It actually uses 30% of the energy consumption. That's what I think bankers like as well because if you reduce your energy consumption, you reduce your expenses, and with high energy costs, especially these days, it makes sense to those bankers. And then if you look at the new upcoming development in the next few years, Singtel call center, was the net zero building or carbon neutral building. So then in that sense, being bankers like minus such assets. So yeah, in short, borrowers are having this conversation with us, but I guess this also because we are in Singapore, that countries can handle more.
So are Singapore borrowers are not so smarter, or is just the situation here a bit more stable?
Stable as well, I think we are more prudent. I think this is our DNA in them. We actually work for what's happening rather than you feel in actually you mentioned about data centers. So in Singapore, I think our borrowers actually stable in data centers. We really having who the tenants are they have in mind. But I guess some other countries or some other companies that have overseas, they should look and pray for best, hope for best when you
Maybe one last question before I take questions from the floor. Maybe yeah. So if you are advising a mid-sized real estate owner in Southeast Asia with a mixed quality portfolio and but has a limited sustainability capex budget. So what's the first thing that you advise them? How do you spend his money and wind that before anything else? So how will you prioritize and strategize your need or internal team?
Okay, thank you, JB. So your question is, if given a limited sustainability budget of Capex, what am I going to advise for a medium-sized portfolio in Southeast Asia? So I guess first and foremost is again go back. We have to go back to the investment thesis. What is the holding period? What is the exit strategy? And of course, the period exit strategy, as well as sorry, I cannot remember the point. I'll come to it later. But to answer his question, and it's very straightforward, will be our good friend here, Justin. Do something what the banker said, because again, it's a cash flow thing. You need to have money, and if your building is old, decrepit, it's very hard to convince banks to lend you that because it will ultimately become a stranded asset. So one of the things that I feel that they should look into, okay, besides the investment thesis, is that what are the material risks? So of course, we're all very familiar with the climate risk. So there has to be we need to have climate adaptation measures or mitigation measures. Then the next thing we look at, are there any easy quick wins? Like let's say if we change, you get a green building certification, when we do some retrofitting, can we change the LEP? So there is no direct answer to a chicken's question because again there are many variables to consider. So if I were in that situation, I would advise the team to say, what would you do to convince, all right, the bank to lend you money? So you work towards that reverse engineering, and that's the easiest way to do it. And before I wrap up on my end, I would like to touch on what Joanna shared about data collection. And I feel that is not just unique to an operator. Actually, even for an asset manager, data collection it's key and it's non-negotiable because data collection or the data set is not a sustainability output. It is a precondition for a sustainability output. Without that, you cannot measure. How can we tell the banks that you're going to improve the performance and show that it's not a stranded asset? And before you want to come up with any initiatives or you want to invest in anything, you need to have data sets to establish the baseline. So that is very important. And from our point of view as an asset manager, it is the key thing. Really, if you have no money or stuff, maybe start with data collection first, then we can move on to some of the other things.
How will sustainability initiatives translate to increase in building valuation?
I'll start first. In short, it is something that my team is still working on. No, seriously. Having been in the sustainability area for the last 15 years, I feel that there's a lot of interest in sustainability because it's very sexy. Everybody loves it. You want to save the planet and do good. But I feel that in the area of real estate, we need to bridge the gap. This understanding between sustainability investments vis-a-vis what are the returns. Is there or should I say, how does it affect the underwriting? Is there an improvement in the asset valuation? And sometimes it is not just about getting better interest rates from banks. You also have to look at the capital market. Is there an appetite, all right, in this region or in this market for even green building certification? So if let's say my company, my firm, we invested in say a office building in Vietnam. All right. And all the other office buildings in the vicinity, they also have LEED certification. So of course we have to go for it and then we'll try to find a way to understand what are the returns, the premiums, so that it makes a business case, a business sense for the other projects to also follow suit to get similar or to adopt similar initiatives as well. To also add on to that, eventually the building valuation is a function of how much rents that you can get. So different regions within the country have different green premium dependent on what's the supply and demand of the area itself. So in a city where the supply of rental green premium rebuilding is quite rare. So everybody is agrees with it. So if you get a deep platinum versus a deep gold, the rental increase might not be that much. As a result, building valuation may not see a this increase. However, if you're in a different city where your office is only one of the being certified, and there are a few MNC who is needed on the corporate sustainability level, required this elements there, your building valuation as a result of your plans will definitely increase that. So I think it's not a one size fits all. It really depends on the demand and supply of the green building itself versus the rental demand that comes from each and every one.
Actually, we were having this conversation a few days ago as well. So it boils down to supply and demand. Like what Fiona very pointed out, if there are very a few big units and and we have a 6-star or a 5-star papers in Australia, obviously pay more. And also, and this is one of the reasons that last month we financed asset, we should talk about offices and managers because they all have my and do power green green clean.
This is a debated topic about how sustainability actually translates to a higher building valuation. So I think first of all, it's that from if you choose your sustainability initiative correctly, you should see a lower operating cost. And so from a lower operating cost, this actually improves your net property income. So with a cap rate of let's say 4%, and for every dollar of a net property income that you generate on a yearly basis, it actually translates to another 25 times return. Which actually means that when you practice sustainability initiatives in a way whereby there's a lower operating cost from energy savings, from water savings, or less use of resources, it translates to a more uh, to a better net property income, which correlates to a higher building valuation. Okay, because there's an improvement in net property income. And there is also studies from various corporate real estate companies that there's always a green premium in terms of adopting the green mark framework or LEED framework. So there's an indirect impact on operations. So the beauty about having a LEED or green mark framework being enforced with your building operations team is that everybody has the same vision. So for example, today if you want to have a total system efficiency of let's say 0.7 kilowatt per ton, whether you are the center manager or MD that owns the building or the technician on the ground, you share the same KPI. So we consider this as a line of sight from the top management all the way to the field technician on the ground that we all have to achieve the total system efficiency together. So this translates to a discipline in building operations that on a daily basis you are required to meet KPIs. So what makes green building translating to a green premium is that you get better service, you get better reliability, and because you have the discipline in operations. So this is where I think the green premium comes. And of course, as the green premium develops as a benchmark within the country, then probably we have to talk about the ground discount, whereby in UK you'll find that if the buildings are inefficient and up to a point whereby they cannot be leased out until you sort out the energy efficiency in Europe. Okay, so this is where the ground discount kicks in when the green premium no longer have a significant factor. Yeah. So I think this is where the sustainability can builds into the industry. You not only get a green premium, you also get a norms.
Just to share to provide more context. So the portfolio that my company oversees it's a very diverse asset class and covers across Asia Pacific. So while we've been talking about premiums and stuff, what I noticed based on what I noticed based on developments is that we hear a lot about green premiums when it comes to say office buildings, retail. However, when it comes to other asset classes like hospitality or even logistics or in different regions, say in Japan, Korea, and China as well, it's still hard. I mean, on my side, my team is still face challenges in trying to convince the deal teams that there is actually green premium for say a logistics building to get a green building certification. So even though we have secured that, the next step that we're working on is really to try to, come up with some sensitivity analysis and to show that, hey, you can price this into exit strategy. So I feel that maybe if whoever is in the research area or something, maybe you can start looking into other asset classes besides office because office, the office asset class demonstrates a very strong reason, a very strong business case when it comes to green premiums, but less so for other asset classes in other parts of the world.
Okay, maybe I just keep it up. Let me show. Maybe we'll take the next question for Dusty. Justine. From your experience, are the green requirements for green loans, sustainability linked loans, stricter for Chinese banks versus Singapore banks or US banks?
Just maybe just to clarify, the difference between green loans and LL. Yes, the green loans need to abide by some of contributing green loan consumers. So, in the abide by this point, it's called a green loan. SLL or a short subsidiary green loan. It's all it's linked to ESG. So it can be linked to the environment, the society, or corporate governance. So I can very important book, for example, climate debt, and then you can have a promise or a documentation you reduce the, for example, in 100 fail workers in your organization. Then to the SLL loan, you say that instead of having 100 workers, you can change it to be you have green value of selling of the on there and says so that's so and then back to the question, is there any different standards? I guess SLL is a bit debatable. For a GLC, right? Sorry, green loan, you need to apply for the first, and because of that, I won't say it's easy to very sensitive to greenwash or what, but they are quite pretty strict principles you need to abide by, the certification reporting and proceeds. So it's a bit harder. So if I mean, given a choice, I would rather do a green loan than an SLL. Okay.
Maybe I bring more question for James. So I think owner invests while tenants enjoy the operation savings. So what type of commercial model has been successful in aligning both parties?
For green lease, you have to understand which perspective you are going for. So a lot of times for green leases, when you go into an office with a let's say new owner, the owners for us, the tenants, is that we have to come in and we pay the money to have sustainable fit out within our office space. However, as of now, we do see a lot of enhancements, not only in Singapore but in Hong Kong. And we recently visited one in India where we get the landlord to commit to us and tenant some of the clauses that they will do. Some of which is ensuring that they will maintain the green building certification, looking at the EUI targets that they will achieve for the space. So if I could put it in place, in the previous years, some of the green houses that we look at are very landlord focused, where they have a say telling us what we should put in and some of the fit up requirement have quite a bit of sustainability aspect to it. In recent years, there has been pushback to have them commit on some of the key aspects to us, to have them agree to what we want to do. So I'm not sure. It's not a kind of a commercial setup process, but it's knowing when you come into the table to discuss and have the right time to discuss on green process. If you come in at a stage that is way too late, most likely you won't get what you need. But if you're able to have that put into place together with the mental discussions, that's when you have more chance to get your green process as a tenant play in that inside the tenancy. Occupier tenant perspective, to have sustainable success doesn't come when the office is safe. I think that is the keys that anybody who's coming in and taking care of corporate real estate should do. In sustainability, impact, and success come way ahead where you select your green process and you design it. So blue property integration is the key for sustainable operation success.
In short, if you borrow money from bank, try to think ahead of that. Building, try to look at my perspective. So use the entries and then you have like
Thanks. And from the asset manager's perspective, I guess when it comes to doing sustainability stuff, the first question we should ask is, why are we doing it? Like it should make sense. So it always goes back to the bottom line. Thank you.
What we've heard, I think decarbonization is actually not a destination. Okay? That you arrive at. I think it's a transition that we manage across capital, across risk, across operations, and across the county. And no single stakeholder can do it. And investors need financial yes. And that's why we have to actually focus on various strategies based on core plus or value add assets. And banks also need private operators. Okay. So operators need to know how money talks to you, how money talks to the bankers. Okay. And operators also use good technology that works. And most importantly, they have to be willing to commit stable life. So I think that there's one takeaway for this session. There's alignment actually matters more than efficient. So even if we do partial progress and some small wins, I think honestly it's having a great plan, but when we never release the boardroom, I think there's a dysfunction between boardroom targets and execution. So I think